Hi everybody, it's Terry Ryder from Hotspotting. It's that time of the week when every week we publish our free weekly newsletter called The Wire. Wire stands for Week in Real Estate. And in it we highlight the half dozen major stories around real estate markets in the week that's just passed. Headlining this week was the latest decision from the Reserve Bank of Australia on the official interest rate. The media sort of waits breathlessly for this decision on the first Tuesday of every month. I'm not sure why there's so much focus on it, because it's become kind of irrelevant in the lives of average Australians, including those who have mortgages. It's the 17th consecutive month in which the Reserve Bank has made no change to the official interest rate, and it has indicated that it's not planning to change the official cash rate anytime soon. And while that's happening, in the background, lenders are moving their mortgage rates up, down, and sideways. There's constant movement in rates depending on where they want to concentrate their competition. And what's going on with the Reserve Bank is become a little bit irrelevant in the lives of average Australians. As Louise Lucas says, Louise is the CEO of the Property Education Company, one of the leading mortgage brokers in Australia, says although we're seeing no movement in the official rate, lenders are making their own rate adjustments. Well, yes, they are constantly. For example, in the past week, the Commonwealth Bank, the biggest bank in terms of mortgages in the country, has changed has cut its fixed rates for investors. And you'll remember that APRA has had a recent clampdown on interest-only lending. In this case, the Commonwealth Bank and also some of the other banks are indicating that they're back competing for that kind of business. Researcher CoreLogic also said in the week just past that it believes that loans to investors could start to pick up again because banks have largely complied with the APRA limits on new loans, particularly those relating to interest only. There's another story out this week which said that wealthy Australians are getting richer quicker. And that's happening at a faster rate than the rest of us, not because their incomes, their wages are growing faster than everyone else's, but because they are investing, probably because they can afford to. The wealthiest top 20% of households, their incomes are growing 50% faster than average households, and their net worth is rising at twice the pace of average households. This is based largely on comparing incomes between two census events, 2010, 2016, or rather information that existed at those times, which found that the average weekly income for the highest households earners rose 12%, whereas the average households rose 7 or 8%. The net worth of the richest climbed 15%. The average net worth of the people in that richest top 20% is almost 3 million, whereas those down the bottom end, their incomes, their net worth has risen less than 1% to 36,000. So there's quite a big gap between rich and poor, and it's happening because the richest are out there investing in real estate, shares and other things, and poor people are just making ends meet. APRA indicated this week, APRA Chairman Wayne Byers was reported as saying that he believes that the 10% cap on the rise in lending to interest rate, which they imposed in 2014, has pretty much run its course, has reached the end of its useful life, and is probably no longer needed. So they're thinking about scrapping that. Byers says that that particular speed limit that they imposed almost 4 years ago has become redundant because bank lending standards have improved and everything's back into line as far as APRA is concerned. But it says it's got no plans to change the more recently imposed cap on interest-only lending, which was introduced only in April last year. He says we'd like to see how the industry settles before we're thinking about removing that one. A couple of stories out there this week relating to the never-ending discussion about housing affordability. The Housing Industry Association published its most recent affordability index, which indicated that nationally there was a slight improvement in the December quarter, and also that in the 6 capital cities other than Sydney and Melbourne, affordability is now better than the 20-year average in those particular cities, partly due to low interest rates, but also noted that affordability is slightly improved in Sydney because home prices now are slightly lower than they were a year ago. But it all depends on how you measure it and how you look at it, because there was another affordability report out recently from a different research source that had slightly different results. The other story that was out there, there's been a lot of actually different coverage about affordability this week. The Housing Industry Association, which has a lot to say on this issue, but nobody really listens to them because they see it as the voice of vested interest, the voice of the building industry, the developer lobby, and their argument that they put out this week is that housing affordability problems where they exist in our biggest cities is the product of 2 decades of policy neglect by successive governments at various levels. And they say that for too long, governments have chosen quick fix options in answer to the affordability issue rather than taking long-term decisions. And it says we need to resume the discussion around tax, especially where it applies to land and housing, and put an end to the upfront taxes that are keeping so many first home buyers out of the market. But while all that debate about affordability is going on and what causes it and how to fix it, the level of buying activity by first home buyers at the moment is the highest it's been for 5 years, and it's particularly high at the moment in relative terms in our 2 biggest and most expensive cities, Sydney and Melbourne, partly because the state governments in those states have introduced some attractive incentives to help people along. Apropos all of that, the report of the week in this week's edition of The Week in Real Estate is the new edition that we've just published of Cheapies with Prospects, City Edition, the top 5 cheapies with prospects locations that we've highlighted in the capital cities. It's one of our most popular reports, one that we update every three months. This is the latest edition, and it's important because it's an answer to that affordability problem for people who are on a budget. As home buyers or investors, it's a good report to look at. And this coming week, we're going to be publishing the regional edition, the regional equivalent of that report. Quote of the week this week, referring back to APRA Chairman Wayne Byers, speaking to a Senate Estimates Committee in Canberra, when he said the 10% investor growth benchmark that we introduced some years ago is probably reaching the end of its useful life, indicating that APRA is planning perhaps to remove that particular speed bump to lending to particularly to investors. So that's the highlights of this week's edition of The Week in Real Estate. It's a free weekly newsletter. It's a good way to stay informed about the major issues that are going on in the background to residential real estate. And if you'd like to get a copy, it's very easy to do. Go to the hotspotting.com.au website and click on, there's an icon section on the homepage. Click on the button that says yes please, and it'll take you through to where you can put in some simple details and start receiving that free newsletter to stay informed about what's going on in residential property around Australia every week. That's it for now. Thanks for listening. Terry Ryder from Hotspotting signing off. Talk to you again soon.